billions of dollars in deals today, and you really do have to wonder if it means more are coming in the fourth quarter. Joining us to talk about this is Bob Profusek. He's the head of mergers and acquisition over at Jones Day. Bob, great to have you back with Matt and me.
Nice to be here.
Is it all about just finding new areas of growth at this point?
Well, it's about a lot of things. So certainly,
as it always is, right?
Yeah, it's a tepid growth environment in the West. On the other hand, M&A is very active in Asia, where there's a very high growth rate. It's an incredibly liquid world right now. There's just oceans of investment capital. Corporates are sitting on tons of money on their balance sheets. Private equity firms, which nobody's talking about these days, but don't count them out.
Right.
They've got a lot of money and a lot of money available to them. But really, I think, and that's probably what's this spurt that we've really seen since August. I mean, remember this all started in August.
Though.
Yeah, and I think I expect it to continue because of the bigger factors. Globalization. The Walmart deal is a good example of that. And just all the business process change that's affected by technology. It's changed, people, you talk to any CEO, they're saying, I've got to change the way I'm doing business. I'm not going to be selling the same products 3 years from now that we're selling from today. Everything's moving. So you see deals like 3PAR last month. I mean, it was extraordinary transaction. So there's a lot of things, but I really think it's the sort of, I'm not going to give him a plug for this, but sort of the Tom Friedman factors that are really going to ultimately keep this spurt something more than just a blip. I think we're headed into a real boom time for M&A.
But is it very positive for the market, though? Because you say targets don't see a point in the near future where they're going to get much more anyway, so they acquiesce. I mean, it's not a very positive sign for 2011.
Well, it's not a good sign in terms of a macro GDP kind of thing. There's no question about that, and that's what we were just talking about. But it's probably a sign that, frankly, on the buy side, I mean, don't forget what we went through in the sort of post-Lehman environment. We went into a period where risk was elevated to the number one factor. Companies are not doing deals, and private equity is not pulling the trigger either unless they're very comfortable and very confident that it makes sense strategically and financially. So it's really both. And it also means, I think, your point, which is that companies don't expect their stock prices to pop right back up to where they were pre-Lehman. Those days are gone. So getting used to this sort of modest macroeconomic environment.
Adam, I want to go back to you because you did talk a lot about the growth issue and why we're seeing some of this in terms of the deal flow. What is, though, the growth outlook for the overall market at this point?
Well, I'll tell you what, Bob just hit the nail on the head. Take a look here at the S&P earnings estimates. 2007, all the companies in the S&P earned about $82.54. Obviously, we had the dip. This year, 81, almost 81 bucks. We're still not back to where we were. And you look at next year, 87. That's not exactly dramatic growth. It's that slowing growth. So it's about trying to find opportunities where you can, finding growth where you can, given a macroeconomic backdrop that's not that positive. And Bob, I guess that's really one of the reasons why this is all happening, isn't it?
Yeah, it sure is.
Are there industries where you're going to see more of that? I mean, are there industries where you expect more M&A growth because of this picture?
I get this question almost every time. I think it's easier to figure out the industries that aren't going to have M&A. I mean, one area is surprising. You would think healthcare would be active right now. Obviously going through a really wrenching transformation, but things have been modest in that space.
And it was at the beginning of the year, before the legislation passed.
Before Obamacare, that's right. But energy, natural resources, tech obviously has been on fire. I think you're going to see a lot in the consumer product space. Infrastructure, which has been not so big, but you're going to see a lot. Everything's there now, and again, I don't think it's a macro factor. This is an environmental factor, but we can't forget that money is unbelievably available and very inexpensive. So, from a cost to capital point of view, you've got. You can do if you're a BBB credit, you can do a 10-year note deal at 4.8%. That's good money, and you ought to be able to beat that in terms of growth rate organically over that period of time.
Bob, you represented Continental in the Continental United deal. Are we done in terms of airline consolidation this time around?
I don't ever say you're done in any industry that's consolidating. It's sort of a musical chairs game. Pull one chair out, all of a sudden there's an odd man out or odd person out. And so
who's still the odd man out if you look at the airline industry?
It's hard to say. I mean, the one thing about airlines, you're not going to see multinational ones. There's this nationalism to that industry. But, I'm not saying anything that anybody couldn't say. This is not based on inside information or anything. But, U.S. was talking to United before the Continental deal happened. Might be logical. American has got to do something.
Well, Bob, let me jump in if I could. Interest rates being as low as they are, could we see a pop in LBOs or at least debt financing in general because of the low rates?
Well, I think so. And in fact, let's not forget, one of the things, in 2006, there was an enormous amount of private equity capital raised, usually on a 5-year use it or lose it basis. That ends in 2011. So there's a lot of equity committed to private equity, and these interest rates are good. And while the high-end credit markets are good, actually the high-yield markets are even good right now. So don't count those guys out, but you're going to see them in the sort of 500 million to 3 or 4 billion space, not these mega deals.
But 5 seconds, the pace continues. You still see more deal flow coming in the fourth quarter.
Fourth quarter, and I actually think 2011 is going to beat 2006 in terms of total volume.
Oh, wow. That's
it's going to be a blockbuster.
Oh, wow. Okay. Got it, Bob.
A lot of
thank you so
action
much.
still there. Thanks very much, Bob Profusek from Jones Day.